investments as you approach that year.
For retirement, yeah.
So it's a very set it and forget it, like Frank said. And they label it two different ways. Okay, so there's asset allocation is what we are referring to. It's like the asset is the investments that you hold in your account, and the allocation is it in equities, is it in fixed income stuff?
Equities, we're talking AT&T, Apple, Google.
Stocks.
The underlying stocks, growth stocks, technology stocks, all kinds of the different sectors, consumer goods.
But limited to what is available to you in that fund.
Right.
Yeah, you might not be able to get those stocks. They're limited into what funds are available to you. Yeah, but you're using it.
The listener possibly understand what an equity is a stock.
Yes.
It could be in various portions of the U.S. economy.
Yeah, you might look at it as aggressive versus conservative. So the closer it gets to that date, then or your age, the more you want to move to a conservative allocation balance. Okay, the same thing applies in the rule of 100. So the rule of 100 works like this. If depending on your age, that's how you determine the balance of aggressive versus conservative. So if you are 50 years old, you should have half in aggressive, half in conservative. If you are 80 years old, then you need to have 80% in conservative and 20% in aggressive. But if you're 20 years old, you want to be 80% aggressive and only 20% conservative. Now, these are basic rules, generalized investment rules.
Yeah, I've read some articles too on this topic where they start at 110 because of the increased age of many Americans. They're living so long that in order to have their portfolios last long enough, that they need to increase their equity exposure. And so instead of 100, maybe you start at 110.
Yes, more modern.
Analysts believe
because people are living longer. That's why we have to do all of this planning so they don't run out of money. And but my point is, these are very generalized ideas, and they're not customized to like the story that you told initially. What is retirement to you? Traveling, and it's not like a real targeted approach to accomplishing your goals. It's just a blanket idea, and I like a more strategic approach on helping people get to where they want to be. Now, if you just flat out don't want to use any help and you want to just set it and forget it and kind of you end up where you end up, then yeah, this is great.
You're happy with mediocrity.
That's perfect for you. But I don't really think that's why you go to work every day. Look at how many people are just burned out in their career and they don't know when or if they can retire. So there's two approaches to this asset allocation. One is the strategic asset allocation, which involves setting target allocations. So 2045 is the target. Setting target allocations across, various, how do I go back? Because I just hit the button. Technical difficulties, sorry, I was reading and then I hit a button and now my words are gone. Okay, we're back. Setting target allocations across various asset classes and rebalancing the multi-asset portfolio regularly to stay close to the assigned allocation through all market conditions. So market conditions, all market conditions is the key words there, versus tactical, which is what we're about, tactical asset allocation. So the difference is tactical, is not going to just migrate you no matter what's happening in the market, no matter what the market conditions are. Tactical asset allocation encourages adjustments to a portfolio's asset mix based on short-term market forecast. Okay, so what's going on in the market right now? And tactically being more involved and engaged and making moves based off what the trends are. It seeks to take advantage of market trends or economic conditions.
Sounds like a lot more work.
It is more work.
A lot more work.
But what happened? What do we know
about?
about work? Work is what creates productivity. And what are we trying to produce here? More money. We're trying to produce a reality for people.
Set it and forget it, and somebody will take care of it, right?
Yeah, I don't have to do the dishes. The good news is they'll be there when I get back. But productivity comes by actively managing. Remember that word, active. Okay, we want your 401k. The problem with 401ks, and this is a quote that I literally took from Vanguard's Institutional Wealth article. It's target date funds serve a large and diverse investor population. So large and diverse. Think about those two words when you're thinking about all middle-class America out there working day in and day out to keep this country going. That's a large and diverse crowd, right? It is. And so that's who they're referring to. A large and diverse investor population, many of whom are defaulted by retirement plans into target date funds.
Right, so what happens, what you're talking about specifically, many employers have, because as we talked about, life is so busy. I got children, I just got my new job, I'm starting my employment, all the tons of paperwork, and there's a retirement option available. I never did the paperwork, never went to that seminar to learn about my retirement programming. They will put you, if you don't make any options, into a target fund for your retirement. This is what happens at some employers.
Yeah, it's default.
It's default.
It's default. You know, you come to work and you do your job and you know that you're contributing to a 401k. You know one day you're going to retire and you just do your part, assuming that the company in this 401k that you're contributing to is doing its part. And a little bit it is, but it's not to the level that you deserve, okay? This is the problem that I think is a huge issue with middle-class Americans and their retirement accounts, and they should be retiring with way more money than they actually are. And if you do anything...
But to be fair, too, is that what we're explaining is not just because potentially it sounds like you could be hearing that Mindie's saying that we're going to take more risk with your money.
No. So, leading into exactly what, why that's not right. That's not true. That's not the alternative.
We're saying, there are all these cookie cutter options out there, and you're settling for mediocrity. But hey, we have these golden egg for you.
Well, what it is being in a target date fund. Okay, is taking a very passive approach. It means that when tech stocks are booming, you may not be partaking in that because of where you are in the target
portfolio is in tech stock and the rest of your portfolio maybe is down,
or you might not have it available to you,
or it might not be available.
It might not be available to you, first of all, because you're in a target fund, which is a very basic approach.
It would have a sector of technology in it, more than likely. A portion of the allocation, the strategic allocation.
So what would happen if you're with a tactical manager?
Right, they would be looking for the market trends in the market and now doing continuous market analysis.
What is the incentive for a target fund to grow your assets? It's preservation. It's all about preservation and following that rule. They are locked into that rule of balance, asset allocation, 20% or 80%, 40% or 60%, depending on how you're approaching. Tactical investment is what the wealthy do. The wealthy investors are not just putting their money in a target fund. They are tactically investing and they are making moves all the time with their money to grow it. And that's what I'm saying. There is a way for you to do that in these accounts, these 401ks, these 457s and 403bs.
And to protect downside risk.
And protect downside risk. As a matter of fact, more opportunity to protect your downside, to protect you.
Actively managed.
Exactly. So let me read this quote for you. This is from Financial Engine's Aon Hewitt, who some of you may have assets with, right, through your 401ks and so on. They're custodian. They did a study that the annual median performance gap for return between investors is for a 45-year-old participant, so 45 years old, that seeks the help of a financial professional, Frank and I, it could be translated to 79% more wealth by the age of 65.3. 79% more. And what is the difference? The difference is not being in a strategic, passive, set it, who cares what's going on in the world, just get me there.
We're not saying you're not going to make some money and have some returns, right? But how can you enjoy higher returns and better returns with a little bit of extra time and planning?
If this study is correct and a person accumulates $1 million after 30 years of working in their 401k, 403b, 457, whatever, and it could have been $790,000 more.
Is that something to consider?
It's definitely something to consider.
So if you want to come sit with Mindie and I, we have free consultations, absolutely free, anytime to come sit with us and help you analyze and go over your retirement options.
Well, even easier than that, I created a link. It's attached right on our website, and it just says if we can manage your 401k, 403b, or 457. There's 2 questions that we need answers to in order to know if it is something that your company allows, because it's not available to everyone. Although maybe not through us, but we could still direct you on how to manage that. But here's the key, okay? So moving on into the self-directed brokerage account, because this is the key. In order to change, you have to, if you're going to stay within your limited investment options
for your retirement portfolio at your employer
that have been approved by your employer, sponsored savings plan, then you're in those target funds. You're in those limited investment options. In order to open the door to the rest of the universe of investing, you actually have to go and move into a self-directed brokerage account.
SDBA, self-directed brokerage account.
Yes, and every company has its own lingo for that, and we're very familiar with it. So depending on where you work and how you're set up, which are those 2 questions that we're going to ask you, we'll be able to navigate you through that process. It's not something you have to do by yourself. We will help you do that.
The Florida retirement system does have SDBA options.
Yes. So you open that door to the new free world of investing, and then we align. You're not rolling your money out of your...
You still log into the same account.
Your money is still there. It does not change. What you're doing is opening up the self-directed brokerage portion of your account, allowing yourself to invest in these other options, which we essentially sync up to your account and do for you. It's very, very simple, and it's something that is so easy to process and accomplish for yourself. And there's absolutely, in my opinion, no reason not to do it, simply because the universe of investments has so many more opportunities for growth and accumulating assets and wealth for yourself while you're at work. And this isn't something that you have to write a check for. You're not going to spend money to get all of this set up. The fee structure is built into the investment model depending on what you choose.
You're not cutting us a check every month either to help you manage that portfolio.
Yes. Exactly. So it's just a simple 2 questionnaire that is on the website. It says manage my 401k, 403b, or 457, and you answer those questions, and then we see what we can do to help you.
Some of the plans might not have that option, and there may be other listeners out there who are nearing retirement, and you don't have to stay in your 401k, 457, 403b when you go into retirement. That's what we also help clients do, is move. We have the world of SDBA that Mindie has been talking about is available outside of the SDBA as well to any retiree or potential retiree taking your nest egg and having it actively and tactically being managed.
Exactly. Tactical management is just where it's at, in my opinion. And having proactive asset management, right? So people that are incentivized to grow your account, okay? And the stop loss protection that we talked about. Being able to now have a system in place that is actually going to move your assets to cash when the market is tanking, okay? And protect. We have an incentive to protect your 401k, your 403b. We have an incentive to protect your 457. Why? Because if your account value goes down, which it probably right? We've all been experiencing this. So in order to protect that, that's also protecting our income. There's no incentive for some of these funds to protect your money. It's just ride it out, buy and hold, and hope that the market is not down when you decide to retire. Because tactical management is going to try to protect you from that.
The systems we're describing help protect that downside. You should not see, would not see 40, 50, 60% downturns in your portfolio.
Exactly.
With this type of protection.
And most importantly is that when those, let's say the market goes down 40%. Well, guess what it's going to do eventually? It's going to go back up. And if you are fortunate enough to have missed that giant drawdown, maybe you only missed 20% of the drawdown. When it does go back up, you are going to be leveling up your 401k, leveling up your 403b, leveling up your 457.
Right. Now, some of the reasons why this is so important, right? I have a $100,000 portfolio or a $10,000 portfolio that's now worth $5,000. I lost 50% of my portfolio. I had a $10,000 portfolio. Now it's worth $5,000. How much?
Same thing for somebody that has $10 million and now they're down to $5.
Somebody might think, well, if I make 50% back, I'll be back where I was. But no, you got to make 100% back to get back where I was. Your 5,000 times 100% is another 5,000 to get you back. It's not the 50% downturn. So as you keep experiencing larger and larger downturns, it takes more and more of an upturn to come back to even where you were.
And this is why having a personalized approach, having an advisor that you can sit with, that you can talk with, that you can give all of your information to, all of your financial information and all of your goals, and create an overall strategy and an overall plan that year by year, change by change, even changes in the economy, changes in the market, we can adjust that plan and have a team that's working for you to protect this money and grow your money. That way, when it does come time for that distribution phase, you're able to afford the things that you want to do and possibly retire sooner than you thought was possible. Right. That's big. It's big for me.
Reminding too the listeners that the stop loss protection we're talking about is proprietary, mathematical, non-emotional indicators which signals when to enter and exit the market. These are math-based trending analysis, quantitative. It's not somebody just in the emotion of the moment trying to figure out what direction.
Yeah, it's a very in-depth algorithm. So Frank, let me ask you something. Are we going to be in a bear market or a bull market in 2045?
Yeah, I would not be able to answer that question. Not accurately. It'd be throwing darts. I think there's a whole story about throwing darts.
So that's the thing with these target funds that I can't get over, is because it's like, oh, all right, you're going to just like slightly shift to a conservative place, but what if in 2045 we're in an amazing bull market and you're not participating in it because you're being too conservative?
I'm going to retire, but I would miss all this.
Yeah, growth.
Of
yes,
this large portfolio.
Huge setback. Or what if you're in a target fund and it's a bear market, and instead of moving you to cash and protecting all this money, instead you're just buy and hold, you're just riding it out, and now you have to work another 5 years or until the market comes back, which I have seen. I know, and I'm not the only one that has seen people who've had to continue to work. Why? Because the market's down when it's time for them to retire, which is
now,
it's very unfortunate, and it's because of poor planning. I'm sorry, but at the end of the day, if I could do everyone's job, I mean, not everyone does what we do. Not everyone has my knowledge. Not everyone has your knowledge.
Well, I wanted to mention that too, Mindy, that we do not collect fees on transactions for we're not broker-dealer.
No, we do.
Investments, insurance. We do not collect fees on or commissions on sales.
Yes, commissions. Sorry.
Yeah.
We do collect fees, Frank. We don't collect commissions. Yes. Commissions are, well, that is the main difference. And the fee structure, we are fee only. We only collect a fee. So we collect a fee for our advice, for our management. And that fee is based solely upon how much money you have invested, right? That's a fee. The fee is a percentage of how much you have invested. So guess what happens to our fee and how much money we make if your investment doubles? Pay raise, we make more money. But what happens if your investment loses 40%? What happens to our fee, our money? We lose. Our paycheck takes a loss. So that's when you're on the win-win. Commission is when you're a broker dealer and I say, oh, buy this fund because it's going to pay me a higher commission than investing in this fund or that fund. We don't participate in that.
Fees I'm referring to
Yes.
are sitting down at our table to get our advice and to go through the retirement analyzation of multiple scenarios that we will sit with and help you to
What does it
understand.
cost for someone to come into the office and sit down or do a Zoom or phone call? What does it cost them to get a consultation with us?
Multiple even, right?
Multiple, yes, multiple consultations, whatever it takes. How much does it cost?
Nothing.
Exactly.
Zero.
That's what you were talking about.
Yes.
We're back on track. We're back on track. Okay, so speaking of fees, speaking of cost involved with having, the reality of it is when something is free or low cost, that's sometimes the approach that we want to go, and we get fixated on, well, what is the fee going to be versus what is going to be the net end game?
Benefit, right?
What is the benefit? What is the value?
Benefit analysis?
Yeah, I was just having a conversation this week about that, and I'm like, look, if we can't provide more value, if we can't produce better returns and better opportunities for you, right? Then absolutely fire us.
Else. That's right. Go with somebody else.
Yeah, but the whole point is that we are trained. We are working with the elite of management teams in the country that are providing amazing results.
And
Results
they're not available to the
public
without a financial advisor.
Without a fiduciary
These
advisor,
managers
yes.
that we're referring to, and the returns that you'll see that are higher than these target life retirement funds or the index type mutual funds, right? They're exceeding the returns.
Yes.
In many cases.
So
You're
going
not
back
able to get to those managers without going through a financial advisor.
And going back to that conversation that I had about the fees with this guy and versus the returns, when we ended up running the proposals and showing, it's just like, here you go. It's in plain sight. Yes, the numbers that we're able to produce better beat the numbers that are out there, right? Or else we're not bringing any value. And it's our job to find those good managers and provide those to our clients. So we have 14 money managers on our platform, hopefully 15, maybe 16, because we have 2 that we're looking at right now that have, we're on this really big initiative to find money managers that provide biblically sound, investment strategies, meaning that they're not investing your money into companies that support things that perhaps don't align with your Christian values. So that's important to us, and we want to be able to offer that to our clients. So we're working on that too.
ESG either.
So going back to the fees and returns, the whole point of this strategy is to see teachers, firemen, police officers, the people that are making this country go. Hardworking middle-class Americans that are out there doing their job, their profession that they're trained to do, but because they're trusting this 401k system that we already said by default, they end up in just by default. Why? Because it's simple. It's a one shoe fits everybody approach. Set it and forget it. There's no work to be done there. So they just kind of put you over there. And because you don't know any better, you don't end up accumulating the assets that you deserve to accumulate.
Not to mention as well, life changes or maybe significant life changes where you might need to rethink and relook at how you're allocating your resources toward retirement. Maybe, unfortunately, a divorce or a death or a childbirth or a marriage.
Right. Life happens. Things change. That's why these plans are always flexible.
And I wanted to say, just in summary, we've been talking about 401ks, 457, 403bs, where you have retirement plans. You may have an option to open up an SDBA, self-directed brokerage account, and have your money invested outside of the options that are available through your employer, yet not closing your account, but through that existing account where you have tactical management of your retirement assets with a much higher potential for greater returns than you would see sitting in a cookie cutter plan that you might get through your employer.
So just two questions that you might be thinking. Again, I want to reiterate, you're not leaving the plan, okay? You are staying in your 401k, you're staying in your 403b. Like, for example, if you're with Florida's retirement system, you're not leaving the system. Everything with your paycheck stays the same, your contributions stay the same. All we're doing is redirecting your investment strategy within that account. That account doesn't change. Everything stays the same.
Yep, your login password still going through the same.
What we're saying is you can have more freedom, you can have more control over what you're investing in, and that's the window of opportunity that I feel like is closed for so many hardworking Americans, and I don't want to see that.
In addition, though, to be clear, right, Mindy, we're talking about like for sitting with Mindie Molina, Investments and Insurance, sitting with Frank, myself, or Mindy, and you open up this account. It's not like you're going to have to, out of your paycheck, send us money every month, right? That the retirement account.
No, just like the target funds.
Funds the fees that we've been referring to.
Exactly. Just like the funds that you already have, those funds are providing.
They have management fees. They have all kind of fees in them.
Yes, those fees are no different, well, every fund has a different fee, so I don't want to use the word different, but yes, the protocol is the same, okay? You're right.
To sit with us, I'm just explaining to the listener, potential client, that they're not writing us a check.
No. You're just really taking advantage of an opportunity that you might not be aware of that could really, like I said, 79% more money in retirement if you're 45 years old. 79% more in your 401k when you are in retirement age than what you could possibly have. Obviously, it's a study, but still, it is a great opportunity, and I've seen it. We have a gentleman, a mutual friend who retired very early he was a police officer, right?
Sheriff,
yeah, sheriff.
County deputy or deputy.
Same deal. FRS system, did the investment plan, did the self-directed brokerage account.
A savvy investor himself.
Made good investment choices. Tactical.
Managing his own very tactical.
Tactical management.
Active.
And accumulated enough that he retired in his 50s. Very early. Yeah. And I want to see that for more Americans. It's possible. And just like one of our money managers, Vance Howard, he took it on himself as a challenge for one of his family members who was also a police officer and said, I can double your money. And the guy's like, okay. And he did. He doubled his money. Why? Because of tactical management. Being in these passive funds and the set it and forget it, it's just, it's okay, but it's just not as productive as it could be. Think about how hard you work and how much time you invest to your job. Make that money work for you. Your money should be working alongside you during that accumulation phase of life.
Making sure you're getting your match as much as you can. Your employer's going to match. You should be utilizing that.
Taking advantage of the match. And I would also like to talk about a Roth 401k.
Oh my goodness.
Yes.
Oh my goodness. Do we ever think tax rates will increase? All right. I believe we're at historical.
What are tax rates?
Look at the tax rates currently over historical time frames. We're at lower tax rates than we've been.
Oh, yes.
On average.
And what are the tax rates going to be in 2045?
Yes, I cannot calculate that. Will I not? I will not know what those rates are. But if I can
None of
pay
us
my
do.
tax now, and then everything that is in my retirement account, if I pay my tax now, will grow. Everything that grows, my principal, will never be taxed again.
So he's talking about a Roth 401k. So a Roth, if your company offers you to contribute to a Roth, then I highly recommend that you do, because sometimes it's like we know the word 401k, we know, our retirement plan, but the word Roth, we're kind of like, actually, this is a huge opportunity. It's very limited on what you can contribute, but that's because the tax situation is even better than a regular 401k. or 403B or 457. If you can do the Roth, what you're doing is contributing portion of your paycheck into that account, and it works the same way, everything we've been talking about in terms of the SDBA and getting management from the free world versus what you're limited to in your employee sponsor plan. But the Roth is going to grow. What you're going to pay the taxes on it before it goes in, your income tax. But everything that it grows, all the gains between now, say you're 45 and when you're 65, all the gains that you earn through your investment and through the market.
Plus your principal, never taxed again.
Never taxed again. That's it. So when you do retire and you're getting this income, tax-free. And what you don't realize is that once you do get into retirement and once you do you can qualify for Medicare, Social Security, your Social Security tax, what you're taxed on Social Security can be impacted by whether you're drawing money from a Roth or a traditional IRA. Maximize that Roth opportunity and do the match. Again, free money.
Yeah, now there may be lots of listeners potentially, and many Americans oftentimes change jobs, and they may have old 401k, old 457, 403b plans that have been sitting from a previous employer for years doing maybe I don't know what.
Set and forget.
Maybe they could have their old 401k, their
Same
old
deal.
retirement plan moved.
Yeah, go on the website, first of all, and fill out that form. That's 2 questions. It literally take you 10 seconds to do. But if you have an old account from a previous employer, like Frank is talking about, it is your, as just a steward of your own financial health, you need to do the responsible thing and roll that over and have it be managed, preferably tactically managed. But even if it's, in a passive way, you need to be managing that money, and you can accumulate. Let's say you've had 5 different positions or with 5 different companies since you've been in your working years, okay? And now you have 5 different accounts, 401ks, 403bs, whatever they are. You can actually, now we're talking about doing a rollover where you leave that employee sponsored plan, you put it into a rollover IRA, and you can actually put all of those accounts, you can consolidate them into one account and manage it specifically. And then if you leave this company that you're with, guess what? You can roll that one over too.
And there's no tax on that?
No tax.
No fees for that either.
But when you say no tax, I need to clarify something because I had this happen one time. One time a lady withdrew her 401k from a previous employer and then had it going around trying to invest it.
She took it into her personal checking or savings account.
She cashed it in basically. And then the 60 days passed and she hadn't reinvested it yet.
And
so she had to pay
20%.
She had to pay the tax. So she was so upset
tax.
because somebody had told her you can roll it over and not be taxed. Well, you need to work with a financial advisor to do that, okay? That's what I'm going to tell you because you don't want to mess that up. It has to go transfer from one institution to the other. That's how I prefer to do it because we don't want an issue where you're paying the tax on something.
And no withholding tax, right? If you take it into your personal account, most of the plans now are going to take a mandatory 20% withholding tax.
Mm-hmm. Yes.
And if you're less than age 59 and a half and you held that money for more than 60 days, you're going to owe an additional 10% penalty tax.
Even more. Uncle Sam doesn't like these tax deferred accounts. Why? Because Uncle Sam wants his taxes now. He doesn't want to wait. So when the time comes, this liability, the lien you have on your retirement account can be pretty costly if you don't have the right strategy in place, even for your heirs, even when you start taking distributions into retirement. These accounts have to be managed correctly from the beginning to the very end. And if you do, it can really, really be amazing. And if you don't, it can really blow up. So it's important for you to take the time to do a little work up front, and then you can set it and forget it. If you put the right team in place and you put the right plan in place, then you can go back to work and not worry about these things and let us help you grow it to the max.
Another point to bring up that I did in my military career with many of you with your employer may have different different options with your HR, with your pay program, with your human resources, where you may be able to allocate different portions of your pay if you receive different types of pay, where you may have bonus pay, incentive pay, sales pays. Like in the military, so I had flight pay, so I could allocate a portion of my flight pay to my thrift savings plan. And staying aware and thinking about that too, especially if you're receiving bonuses, like you could really reduce the burden of your taxes if you're going to receive a $10,000-$15,000 taxable bonus at 25% tax. Well, if you put like 30% of that bonus into a tax deferred savings account, you're going to reduce your tax burden by thousands of dollars. So thinking about those options, being aware of those options, consulting with your CPA for tax specific questions, and certainly considering if you're going to get a pay raise this year and you're going to move into another tax bracket, you could consider Roth is always a
Roth conversion or opening a Roth.
It could be either.
So just to kind of recap everything that we've talked about, one is your employee sponsored plan, right? Your 401k, 403b, and 457s. Those accounts are tax deferred. So at some point you are going to have to start paying the taxes on those, but not until you withdraw the money and actually take the money out of the account.
After age 59.5 without penalty.
Yes. And okay. The other thing is Alight. If you have your custodian, these are some of the custodians that you might be familiar with or that might ring a bell. Alight, Aspire, Charles Schwab, Empower, Fidelity, TD Ameritrade, and TIAA, and even Anon Hewitt that we mentioned before. So I know a lot of what is the aviation place here in Florida? A lot of people work at. It just lost me. Pratt Whitney. Yes, we have a lot of those too. So anyways, it's important for you to take advantage of the SDBA opportunity.
Right, we're saying that those holding custodians have an SDBA option.
Yes. Yes, they should have an SDBA option, and those are just to kind of familiarize yourself with those. But the other thing is maximizing the match, making sure that you're utilizing the match and that you're taking advantage of the tax savings that you get with these types of accounts, and then going online to our website and filling out that link. I'm getting the time card. Filling out that link. It says manage my 401k, 403b, or 457. If you click on that, it's a quick few questions, maybe 4 or 5 questions, 2 that really matter, and we can get back to you and tell you if it's something that we can help you with or what we recommend. So we thank you so much for listening in and being a part of this discussion. Amen. And remember, God loves you and there's nothing anyone can do about it. Be well, my friends.